Imagine buying your dream home, making every home, making your mortgage payments every month, home, and then running into financial trouble. If the home is ever foreclosed, who gets paid first? Your mortgage lender, a home equity loan, or someone else? The answer comes down to one important concept that every homeowner should understand: the first mortgage. Whether you're buying your first house, refinancing, or thinking about borrowing against your home's equity, understanding how a first mortgage works can help you make smarter financial decisions and avoid costly surprises later on. In this video, we'll explain what a first mortgage is, how it works, why lenders care so much about something called loan-to-value ratio, and how it compares with a second mortgage. Let's get started. For most Americans, buying a home is the largest financial commitment they'll ever make. And in nearly every home purchase, a mortgage plays a central role. But many people assume that a first mortgage simply means the first house they've ever purchased. That's actually not what it means. A first mortgage refers to the primary loan secured by a specific property. More importantly, it's the first claim against that property if the borrower stops making payments and foreclosure occurs. That legal priority affects lenders, homeowners, refinancing decisions, home equity loans, and even borrowing costs. Understanding these basics now can make future financial decisions much easier. What is a first mortgage? A first mortgage is the original loan used to purchase a property. When you borrow money from a lender to buy a home, that lender places a lien on the property until the loan is fully repaid. Think of the lien as the lender's legal claim to the home. As long as the mortgage exists, the property serves as collateral for the loan. The word first doesn't refer to the first house you've ever owned. Instead, it describes the mortgage's priority position on that particular property. For example, you could own 3 different homes, each financed with its own mortgage. Each property's original mortgage is considered its first mortgage because it holds the primary claim on that individual home. This priority becomes especially important if the borrower defaults. If the property is sold through foreclosure, the first mortgage lender gets paid before any other lenders with claims against the home. That's one of the biggest reasons first mortgages generally offer lower interest rates than loans that come later. How a first mortgage works. The process begins when a home buyer applies for a mortgage through a bank, credit union, or other lending institution. After reviewing the borrower's finances, income, credit history, and other qualifications, the lender decides whether to approve the loan. Once approved, the buyer signs the mortgage documents and uses the loan to purchase the property. From that point forward, the borrower makes monthly mortgage payments. Each payment usually includes 2 main parts: a portion that reduces the loan balance, known as the principal, and another portion that pays interest to the lender. As those payments continue over time, the outstanding loan balance gradually decreases. If the homeowner later refinances, the original loan is paid off and replaced with a new mortgage. Even though it's a different loan, the new mortgage typically takes over the first lien position, meaning it becomes the property's new first mortgage. Depending on a homeowner's tax situation, mortgage interest paid on a first mortgage may also be tax deductible if they itemize deductions on their federal tax return. What determines whether you qualify? Getting approved for a first mortgage depends on several important factors. One of the biggest is your credit score. A stronger credit profile can improve your chances of approval and may help you qualify for a lower interest rate. Your down payment also plays a major role. The more money you put down up front, the less you need to borrow, which generally lowers the lender's risk. Lenders also review your income, your ability to repay the loan, the type of property you're buying, and the specific mortgage program you choose. Requirements can vary between conventional mortgages and government-backed loans, such as FHA, VA, or USDA loans. For example, FHA loans may allow qualified buyers to purchase certain 1 to 4 unit homes with a down payment as low as 3.5% if they have a credit score of at least 580, provided the property meets FHA eligibility standards. It's also worth remembering that having less than perfect credit doesn't automatically prevent you from getting a mortgage. However, it may affect the interest rate you receive and the overall cost of borrowing. Why loan-to-value ratio matters. Another key concept every homebuyer should understand is the loan-to-value ratio, often called LTV. LTV compares the size of your mortgage to the home's appraised value. If your first mortgage exceeds 80% of the home's value, many lenders require private mortgage insurance, or PMI. PMI protects the lender, not the borrower, if the loan goes into default. While it increases monthly housing costs, it also allows many buyers to purchase a home with a smaller down payment. Some borrowers choose to avoid PMI by making a larger down payment, while others use additional financing strategies depending on their financial situation. Understanding how LTV affects mortgage costs can save thousands of dollars over the life of a loan. And speaking of additional financing, that's where second mortgages enter the picture. In the next section, we'll compare first mortgages with second mortgages, explain why they usually come with higher interest rates, and walk through a real-world foreclosure example that shows exactly who gets paid first. First mortgage versus second mortgage. Now let's look at how a first mortgage compares with a second mortgage, because the differences can have a major impact on both borrowing costs and financial risk. As we've discussed, a first mortgage is the primary loan secured by your home. It has the highest repayment priority, meaning the lender gets paid first if the property is sold after a foreclosure. A second mortgage is exactly what it sounds like, an additional loan that's taken out while the first mortgage is still in place. Many homeowners use second mortgages to access the equity they've built in their homes. Common examples include home equity loans and home equity lines of credit, or HELOCs. Although both loans are secured by the same property, they don't have the same level of protection. If the borrower defaults, the first mortgage lender is paid before the second mortgage lender receives anything, because that creates more risk for the second lender. Second mortgages often carry higher interest rates, There are other differences as well. A first mortgage may require private mortgage insurance, depending on the loan type and down payment. Second mortgages generally don't require PMI, although taking one out could affect the overall financing on your home. Loan limits are also different. A first mortgage is based on the property's purchase price and the borrower's qualifications, while a second mortgage is typically limited by the amount of equity the homeowner has accumulated. So while a second mortgage can provide access to cash, it also increases your monthly debt obligations and financial risk. As a real-world example, let's walk through a simple example to see how repayment priority works. Imagine a homeowner purchases a property using a $250,000 first mortgage. Several years later, after building some equity, they take out a $30,000 second mortgage. Over time, they've already repaid $50,000 of the original first mortgage balance. Unfortunately, financial difficulties arise, and the homeowner eventually defaults on both loans. The home is foreclosed and sold for $210,000. Here's what happens next. At the time of the sale, the remaining balance on the first mortgage is $200,000. Because the first mortgage has priority, that lender is paid first and receives the full $200,000 owed. That leaves only $10,000 from the sale proceeds. The second mortgage lender receives the remaining $10,000, even though the outstanding second mortgage balance is much larger. This example highlights why second mortgages are considered riskier for lenders. Since repayment depends on whatever funds remain after the first mortgage is satisfied, lenders generally charge higher interest rates to compensate for that additional risk. Can you have two mortgages at the same time? The short answer is yes. Many homeowners legally have two mortgages on the same property. Typically, the first mortgage is used to purchase the home. Later, if the property's value increases and the homeowner builds equity through mortgage payments, they may qualify for a second mortgage. That additional loan can be used for many purposes, such as home renovations, major repairs, education expenses, debt consolidation, or other large financial needs. However, qualifying for a second mortgage isn't automatic. Lenders usually evaluate several factors, including your credit scores, income, existing debt, and the amount of equity you've built in your home. Even if you're approved, borrowing against your home's equity means taking on another monthly payment. Before moving forward, it's important to make sure your budget can comfortably handle both loans, not just today, but if your financial situation changes in the future.